What does the expected rise mean for American holidays, foreign economies, and your property mortgages? With the possibility of the US hiking rates today, here is what you need to know and how it could affect you. Why is this rate rise such a big deal? I remember when they used to rise and fall the whole time. The Federal Reserve, the US equivalent to the Bank of England, is widely expected to raise rates today. This will be the first US rate hike since June 2006, when Twitter was barely 2 months old and no one had heard of Lady Gaga. In other words, it's been a very long time, hence why it's such a big deal. Since then the world has experienced the deepest recession since the 1930s. In an attempt to boost the flagging economy, the Federal Reserve cut rates aggressively, their rationale being that the cheaper money is the more likely people are to borrow, thereby stimulating growth, because after all the interest rate is simply the price of money. Does this mean the US economy is finally out of the woods? The US economy has rebounded strongly since the dark days of the credit crunch. The jobless rate is a mere 5%. This is half its 2009 peak and close to what economists term full employment, the maximum rate of employment before which inflationary pressure kicks in. Furthermore, wages are showing signs, albeit meager, of a recovery. Despite this, inflation has disappointed. Although much of this can be explained by plummeting crude oil prices, the core measure, which excludes food and energy prices, is tracking at just 1.3%, well below the Fed's 2% target. So what are the experts saying? Last week The Economist joined the debate, saying it would not raise rates yet, citing concerns over the dollar's strength and ramifications for emerging markets, which could spill over into domestic worries for the US. Citi commentator David Beck has taken a different stance, saying that even if the US economy isn't ready for its first rate rise in nearly a decade, credibility in the Fed needs to be restored, and any move which turns out to be premature could quickly be reversed. If the rate remains unchanged, not only will the Fed lose total credibility, but also indecision could trigger turmoil. What about the rest of the world? I thought the Chinese economy was on the rocks? The Fed has a dual mandate. That means it has two targets. One is to maximize employment and the other is to achieve stable price growth of 2%. On the face of this, both of these targets seem purely US related, but tinkering with one part of the world's economy will mean ripples felt in other parts. As the world's largest economy, tinkering in the US leads to more severe ripples, think wave-like impacts, pretty much everywhere. China, Brazil, Russia, and many other commodity-focused economies have struggled over the last year as commodity prices have hit 16-year lows. Because commodities tend to be priced in dollars, any appreciation to the US dollar would prompt further commodity price falls. In addition, many of these so-called commodity countries have also borrowed in dollars, so an appreciating dollar would therefore make their debt more expensive to service. The Fed will be acutely monitoring the emerging market situation, anxious not to prompt a repeat of the Asian financial crisis in 1997, which needed a multi-billion-dollar bailout from the Fed to contain the financial panic. Does this mean the Bank of England will put rates up soon? Possibly. The UK economy is a slightly different kettle of fish. Unlike the US, which tends to have very long-term fixed-rate mortgages, sometimes lifetime mortgages, ours tend to not only be shorter in duration but also far more likely to be floating, i.e. more susceptible to changes in the base rate. This means that the impact of a 1/4 of a point hike in the UK will be far more severe than one in the US. Interestingly, in the US, mortgage rates have been creeping up for some months as lenders as well as traders price in a rate hike from the Fed. The same scenario will play out in the UK coming months. How soon, is the million-dollar question, but even the rate hike-eager analysts don't see the Bank of England moving until May next year at the very earliest, with interest rate futures, a barometer for underlying rate expectations, not pricing in a hike until 2017. That said, over the last 2 decades we've lagged the Fed by a mere 3 months, so maybe the May call could be the smart one. What will this mean for my mortgage costs? They'll go up. That's the point of a rate rise after all. It takes some of the froth out of the economy and prevents asset bubbles occurring. However, as we've witnessed in the US, mortgage rates will start to creep up long before an official rate rise is communicated. While those on a fixed-rate mortgage will be protected for the term, those on a variable-rate mortgages will feel the heat more quickly. How much more am I looking at? On a hypothetical tracker mortgage, monthly repayments for a £200,000 house, with a £150,000 mortgage, would increase by about £19, or £230 a year. Important to remember though that the Bank of England has flagged that interest rates will return to a new normal of half their historical average, so roughly 2.5%. If bank rates were to rise to 2.5%, interest payments on the previously mentioned mortgage would rise by £165 per month, or nearly £2,000 a year. Given that roughly 1 in 5 homeowners are on tracker of variable rate mortgages, this is not something to be sniffed at. On the flip side though, savers will be rewarded. Last week Barclays, Santander, the Co-op, and HSBC were singled out by the Financial Conduct Authority in list of 32 providers paying little or no returns. Even a modest rise to the bank rate should, at least to some extent, be passed through to the benefit of savers. I am going to Florida next summer. Will it now be more expensive? Most likely, yes. The US dollar is about 3% stronger than it was this time last year. The Royal Bank of Canada sees the dollar becoming as strong as $1.45 per pound next year, making your US holiday as expensive as it was in 2010.